Hello everybody, this is the RITE Report program and I am your host Chris Angle. I'm the author of 4 books on philosophy. These books are available at the philosophicalangle.com. Along with me is my colleague and co-host Rick Samuelson. Rick graduated from Yale and has MBAs from Wharton and Tufts, and Rick is an independent venture capitalist. Approximately once a month we put out a report on the state of the stock market and the economy. This report uses as its basis the RITE Report, which can be seen at stock-market-direction.net. It's a natural outcome of the book with the title The Philosophical Equations of Economics. In that it states that the essence of all decisions come from the risk, the information and knowledge, time, and the effort necessary to make a decision. And of course this would be for a service, and if the product were a material good, it would have an additional factor of material, or land, as the economists would say. Since the major components of these ingredients is information and knowledge and risk, and the RITE Report supposes that if we gather the general information coming to investors, which they use to decide to make an investment, we should have a good tool for prognostication of the direction of the stock market. So with that in mind, the RITE Report was created, and let's go over the current edition to see where it might lead us in predicting the stock market over the next few weeks. First, let's pull that up. First, the RITE Report generates indices from the monthly compilation of corporate, business, economic, and political news. We place these snippets that have a directional bias inherent in the headline, or in the piece of news that's coming from the government, and we use these as factors for predicting the direction of the stock market. So overall, the RITE Report basically uses news and fundamental news analysis to make a prediction as to where the stock market will go. And so let's go over the macroeconomic snippets that we've gathered this month. And we take it from the governmental sources such as the U.S. Census, which talked about new orders. So this is the negative economic ones. And then we have the Conference Board Employment Trends Index declined. The monthly to-date sales in the week ended March 7th rose 7%, though that reflected a big increase in sales at discount from the Red Book, while department stores suffered declines. Sales were led by the pharmaceuticals, cleaning products, household consumables. And then from the U.S., hotel occupancy fell 61.8% in the beginning of March. USA Today reported that stores were cutting hours and closing because of the coronavirus. Bloomberg reported that the cinema industry is in big trouble. And they also reported that U.S. confidence deteriorated. And on MarketWatch, we saw that the New York Fed's Empire State business conditions plunged. And from the U.S. Census, total business end-of-month inventories were down. And also from the U.S. Census Department, privately owned housing starts were down. And single new family houses in sales of new family houses were down. And from the CPB, the World Trade Monitor shows that the volume of world trade decreased 1.2% in January. also from the same source. The scenarios use different starting points. Let's see. This is about the European economy, and particularly the Netherlands economy, and that's predicted to be down. And in the conference board, they stated that they can expect further declines in April. Again, back to the U.S. Census, total construction activity is down. New orders for manufacturing goods decreased. And from the Bureau of Labor Standards, payroll employment fell. But there's some positive news out there, although not a lot. The Bureau of Labor Standards reported hourly earnings increased. The U.S. Census reported the estimate of U.S. selected services total revenue increased. Washington Post reported that the Federal Reserve announced on Sunday it would drop interest rates to 0 and buy a bunch of bonds. U.S. Census reported that U.S. total business sales were up and after-tax profits were up. Manufacturing corporations' after-tax profits were $152 billion for the fourth quarter, and that's up. New orders were up. Gross domestic product increased 2.1%. International trade deficit in goods decreased as exports increased. Profits increased. Personal income increased. But the total of economic snippets that were positive were only 11, and thus in April we collected 61% were negative and 39% were positive. So now we go down to the economic analysis indicators summary section. High yield bonds were down. We also use as an indicator the iShares Select Dividend ETF, and that was down. The Purchasing Managers Index contracted, went below 50%. That shows an economy that is contracting. And the IHS Market Purchasing Managers Index also went down. Construction spending went down. Unemployment obviously has increased, and so that's negative. Productivity is neutral. We had some increase in productivity in the non-farm business sector, but the manufacturing productivity decreased. So we're going to give that a neutral. U.S. Census reported after U.S. manufacturing corporations after-tax profits were up. Retail sales went up for February. That's down. That was down for February. U.S. Census reports that sales were up and manufacturing shipments for January were up. The Industrial Production Index put out by the Federal Reserve of St. Louis ticked upward. Velocity of money ticked downward, also put out by the Federal Reserve Bank of St. Louis. New construction was down, and Conference Board leading economic indicators increased, as well as the coincident economic indicators from the Conference Board. They increased also. New residential sales were down, and the advanced report on durable goods was positive, though. Existing home sales from the National Realtors Association was up 6.5%. There's a positive. Real GDP is from the Bureau of Economic Analysis is positive at 2.1%. Personal consumption expenditures are up Personal income is up. Consumer confidence index decreased. The restaurant performance index was unchanged, but slightly a positive. But we're going to give it a neutral anyway. Corporate profits from the Bureau of Economic Analysis were positive. And manufacturer shipments and inventories, new orders were net down. And the world trade volume, as we mentioned up there in the snippets, that also decreased, so that's a negative. So we had 11 positive indicators, so 13 negative indicators and 2 neutral. So we're going to then go to our investment, to make an investment strategy here, index, and we're going to use the political, domestic political risk that appears here, and we're going to give it a 5 because the negotiations with China was successful back in December, and the tax risk out there is pretty good because corporate taxes were cut, regulations are decreasing, research and development positive as corporate taxes were cut, and the corporate outlook up until this point was pretty good. So production of knowledge has been pretty good up until this point. If we take a look at the market, though, beginning to show the signs of a meltdown. So we're probably overstated this. This should probably be a little lower. Negative snippets were predominantly at 61%, and the economic indicators were down from last month, so we're going to give that a negative 2. So the total is 30, and so then we made the RITE Report strategy index went down to 71%. So the Dow has gone down, and we go here. So we've got 4 categories. Gold is up, oil is down, and the Dow Index is about a little, has been actually going up, amazingly enough, even though gold has also been going up. It's kind of a rare occurrence, but so in summary, we're going to say that the economic situation is deteriorating due to the China coronavirus, but this COVID-19 crisis will start to clearly abate shortly, and the market will methodically advance, one, when a couple of medicines are accepted as being effective against the coronavirus, and they become available to the medical world in large quantities. And secondly, when the testing kits become available, that will allow companies to test their employees so that the ones that are not infected could return to work. And we believe that all this is going to happen probably in the next 30 to 60 days. And so the RITE Report recommends that we begin entering the market now and go long. Rick, what do you think of the situation for the stock market and the economy in general?
Well, it's almost universally accepted that we're in a contraction at the moment. The forecasts vary as to how severe it will be. Frankly, it's anybody. The last I heard on earnings, they expect first quarter earnings to be down, 10% or so. Again, that's a pretty squishy number as well. I would point to what I think is going to be huge dispersion amongst sectors. So, okay, the airlines are going to get killed, hospitality is going to get killed, all of that is obvious. I'm not so sure the information technology sector is going to be that badly affected. Everyone's going to be affected, but I think the gap between sectors is going to be shocking. Well, the oil sector is taking a huge hit, but I've gone back into the market as of a few weeks ago. I don't think the market's cheap, given the earnings are falling, but it's certainly much more reasonably priced than it's been in a long time. What is the current forward-looking PE average for the market? I think it's still closer to 20 than to 12. So it's not cheap, but it's reasonably priced. Bonds don't yield much of anything, and that will be the case for the foreseeable future. In my corner of the investing universe, namely private equity, there's a huge dislocation going on. You're going to see unicorn-style valuations disappear across the board almost. That's happening right now, if it hasn't happened already. This was long overdue. SoftBank gives you an insight because it's publicly listed into what's going on with their valuations, and they're being their investment portfolios being repriced dramatically, and again, that was overdue. So I think one of the benefits of the sell-off is it's going to burn off some of these crazy valuations that we've seen, particularly in venture capital and other parts of private equity, and that I think will clear the way for, as some of these companies actually go bankrupt, it will clear the way for the better run, better managed companies to profit mightily. I would add that I think there's going to be a structural change in what workers demand. In cases where people can work from home, and that's true in a lot of tech, they're going to demand it. No one wants to commute 2 hours back and forth to Seattle, including me. And we've found, my company, that we can do 95% of what we need to do online. You just have to, be clever about it. And I think a lot of other people have found the same thing. So I think there'll be, structurally going forward, there will be less demand for oil in the United States anyway, particularly in those locations where online business becomes more the norm. And you'll see other changes in how people operate not only their businesses, but their everyday lives, some of which could be quite beneficial. I think families spending time together at home has kind of reset expectations about how much time people should spend with family, and I suspect in most cases people are going to value that a lot more than they have recently. So it's not all negative in my mind. I think the structural changes are worth watching in terms of how people work, where they work, what technologies they use to work. That's going to be of more interest in the forthcoming several years than any lasting impact of this overdue contraction.
Rick, in the last couple of weeks, you mentioned you've gotten back into the market, and the RITE Report also last week has recommended to get back into the market, and I myself have done so also. But so here we are in a couple of weeks. Here it is, April 14th, and looking forward, do you see any possibility that the market, although it has started to go back up, could falter and take another dive downward?
Yeah, sure. I think the earnings reports that are going to be coming out will be pretty depressing for the market. So I think it's going to bounce around all summer. It could go, significantly lower. I think the news from abroad will be worse than the news here. I think if you just look at the number of deaths in Europe, it's at least 3 times what we're experiencing in the United States. We have on the order of 20,000. Each European country's got between 10 and 20,000 deaths, all the major ones. I mean, so the impact on them, whatever is happening here, is going to be more dramatic there.
So overall, do you think it's a good time to invest back in the stock market?
Yeah, I think there may be some better buying opportunities in the next few months, but at this stage, if you're investing for the long term, I think it's a perfectly fine time to get in. I focused on companies like Alibaba, which I got into about 3 weeks ago, and then also medium-sized tech companies, because they were pretty beaten down a couple weeks ago. So I've chosen to focus there. Medium-sized companies have tended to be hurt more than larger companies, broadly speaking, across the tech sector.
Well, I agree, and I feel that the best reason to get in the market now is that ultimately our knowledge and technology coming from the private sector will defeat the virus, and with it will come a resurgent market and expand and go upward in the future. If you viewers have comment, you can reach us at the following email address of the.rite.report@gmail.com. Rick, thanks for joining us, and we'll see everybody next month.
Thank you.